Hi and Namaste. You're watching Your Story with me, Sriram Devatha. Today I'll be talking money, or rather managing money, with Shashank Agarwal, the founder of Advice Capital. Hi Shashank, welcome to Your Story.
Yeah, thank you for having me here.
So why don't you dive right in? Tell me why Advice Capital is different from anything else that is there in terms of financial advisory.
Actually, to be honest, there is nothing different which Advice Capital does. So the fact that we don't do anything different itself is different, because today what we kind of find in the industry today is people try and chase sophistication, especially in the HNI space. They say that the simple old methods of investing are too boring, and they try and chase sophisticated investment options, and hence their portfolios typically underperform. So what we believe is, we believe in the principles of investment gurus like Warren Buffett, which says have a long-term view, keep it simple, look at fundamentals, look at values, look at valuations, and so on and so forth. So we in fact actually don't do anything different. So we just follow the age-old philosophies of investment, which somewhere today has got forgotten in the wealth management industry. And doing what is so obvious itself is different nowadays, because people have stopped doing that, anymore.
Interesting. So you spoke about a lot of things. What's interesting is you spoke more about the principle rather than the instruments of investment, right? So can you tell me a little bit about how you decide what sort of investments or investment instruments that someone has to invest in? How do you go about it? A rough approach.
Yeah, so there are two important things in deciding what is the right investment option for a client. The most important thing is to understand the risk. The client has to understand the risk and then communicate to us. And at times we find that the client himself does not understand the risk. Because in investment, what happens is there is something called a recency bias. Now, let's say the markets have done well over the last 1 year. So I'm feeling good about the markets because last 1 year markets have done well. So the client thinks his risk appetite is far higher than it actually is, because he's feeling good about the market. He expects the markets to continue to do well. The same thing if you met a client in 2020 after the COVID, even an aggressive client went into his shell, became very conservative because he was so scared about the environment. The markets did extremely poorly. His current portfolio has fallen 30-40%. So that's called a recency bias. You typically make future judgments based on what has happened in the recent past. So that we try and understand with the ups and downs in the market as to what is the actual risk profile of a client. So a lot of times the client himself does not understand that. The second thing is the time horizon. How long is the client willing to stay invested without needing liquidity from the portfolio? To give you an example, the time horizon determines the risk of an instrument. For example, let me explain about real estate, which most of us understand. Now, you will not buy a property if you want money in 6 months, because it's highly risky. The transaction cost is high. You have to register the property, pay stamp duty and all that. But the same property could be a reasonable investment for 5 to 10 years, because there's enough time frame for the appreciation to take care of the transaction cost. Liquidity is not an issue. You can't get a buyer of a property and so on and so forth in a hurry. Similarly, if you look at equities could be highly risky in the short term, 3 months, 6 months. But then they become relatively safer as the time horizon becomes longer and longer. And hence it is extremely important to keep the time horizon in mind as well, because the very nature of the instrument changes with the time horizon. So what could be highly risky in the short term could be reasonably safe in the longer duration.
That's actually interesting. So given that you've been dealing with the Indian market, or rather the Indian HNI, as you're saying, how has that evolved in terms of the timeline? Do people seem to want to stay invested longer now than they were before? How has that financial literacy bit changed as you've worked through the industry?
I think it's drastically improved over the last, I would say, decade especially. So when I met clients about 10 years back, an HNI client especially, the only investment option he thought was great was real estate. So they would just not look beyond real estate. Now in the last 5-6 years, I've got 3 large builders who today tell me that I want to diversify my investment out of real estate, personal investment. Of course, the company investment they cannot do. But my personal investment out of real estate, because it's all in real estate, and move it into equity. I mean, you would never hear this from an HNI, forget a builder doing that. So I think things have changed a lot. Of course, the reason is also Indian markets have done phenomenally well over the last 2 decades. The mutual fund industry has done well, and with the entire education they are providing, and even the PMSs and so on and so forth. There are a lot of news channels now which focus only on businesses and on markets. A lot of clients are hearing that as well, so they themselves are getting educated. The industry has become wider, So I think there has been a drastic change in terms of the financial literacy, especially with respect to financial instruments. Real estate is something which Indians and gold were something which Indians were comfortable from quite some time. But financial instruments beyond fixed deposits is something which has had a sea change over the last 10 years.
So we were on the point of understanding how this new age, Bitcoin, cryptocurrency, the associated tech with it, whatever that is, how has that sort of impacted high net worth investments?
So if I have to divide this into two, one is the cryptocurrencies and two is technology in general,
Correct.
And not to kind of
Club them together.
I'll come to cryptos secondly, but technology especially, I think, and technology can again be divided in two ways. One is transactional, as to how people are executing, their investments. And the second thing is how is technology making a difference in terms of decision making, both for the client and for an advisor or a wealth manager. Now, in terms of execution, I think COVID played a big role, where a lot of clients have now moved into, even like for discussions into Zoom and so on and so forth, for execution into online platforms and so on and so forth. So right now, my physical meetings with my clients have dropped by almost like 55-60%.
And it's not looking like it's going to recover.
Unlikely for us, so there are a few clients who are still kind of comfortable meeting face to face. But 55-60% of our clients are very happy doing a Zoom call, So they are like, or, use Google Meets or whatever it is. So saying that, okay, we are very happy doing that and, it's convenient for you, convenient for us, and we can do it at any point in time during the day. We don't have to do it at one particular time. So it's mutually very convenient for both of us and the clients are very comfortable. And it's also no geographical presence. He could be sitting in US, for a month and then we can still do a Zoom call and review his portfolio. So that is the transactional convenience which technology is kind of provided over the last, especially after COVID. The compulsions have now become convenience. The second thing is the decision making. Now I think artificial intelligence is slowly creeping in. Where things have become more quant based, where there are computers which are kind of taking decisions, saying if certain things happen, does it lead to certain things which could happen in the future, and hence the decision making in terms of choosing the right asset class for the client. But still, I believe AI in terms of this space has a few years to go, because I think investment is still, a lot of it is art and a lot of it is science. The art portion is something which is very difficult for the AI to learn. The science portion is easy for it to learn. So today, if you look at a lot of successful investors, they may not be the best in terms of knowing the economics and the science behind how to choose a stock, but they're great in terms of the art of choosing the stock. So if you look at in India, somebody like Rakesh Jhunjhunwala, he will not be able to write books on how to choose a right stock in terms of the fundamentals, look at the balance sheet and all that. But his gut feel, his kind of knowledge about the surroundings and what could happen in the future has helped him, when during his investment days, and that's what made him successful. Similarly with Warren Buffett globally as well. So a lot of it is art and just the feel about what could happen and what could be chosen, which is very difficult to put it in words.
Actually, that was going to be my next question.
Yeah.
How, when you say art, it might sound like, okay, he's just running away from an answer. But
right.
If you had to, I know it's hard, to put that into words, what exactly do you mean by art? The quant part is clear. You put numbers, you assess risk, and that's that.
Sure.
But when you say art, what is the best sort of you could give an example or you could try to describe it. I'll leave that to you. I'd like to hear that.
Sure. So, see, and art is something which, or what you call is more the psychology of investing, or the psychology of taking a decision is true in every field. Today, what differentiates, let's say, a successful CEO with a not very successful CEO, the data is provided to everybody. I mean, today, let's say there are two banks and one is highly successful and the other is not so successful. They have enough data coming in terms of, the decision making. But the interpretation of data, in terms of the feel and the hunch and the smartness in terms of how a person can interpret data is something which is very difficult to put it in model. That is what differentiates the highly successful people with the not so successful people. So getting data is fairly kind of easy because the data is common. It's very numerical. But the interpretation of data is what makes a difference, in terms of the performance in any area. It is just not an investment as well.
So how do you learn that? That seems to be such a tough thing to do, right?
Yeah. So
in your opinion?
Yeah. With respect to markets, I think markets are the best teacher. We just had Teachers' Day 2 days back. So it will charge you a fees for the same lesson which it taught you last time and you forgot this time, and you made a mistake. So markets will teach you a lesson again and again whenever you make mistakes or you forget the lessons it taught you last time. So a lot comes with experience, So you have to kind of, so early on I made a lot of mistakes. I still do, so everybody does. But then each time you make a mistake, you learn from it and you try to improve on it. And this is something which just comes with experience, in terms of just going through that situation. That cannot be put in textbook.
Yeah.
So going through that situation, understanding what was the environment at that time and what is the decision I took and what I should have taken, and that probably helps you the next time a similar situation comes, in terms of what it is. So a lot of it is experience, you kind of learn, improve yourself, when you've gone through that, grind many, many times.
Good. I think that's a good answer. But let's move a little bit towards the people side, right?
Right.
On the one hand is your skills towards managing portfolio. The other end is managing the client, or rather reassuring the client, saying that, okay, this is what it is, this is what's happening. What have you learned from that, or how do you approach it?
Yeah, so actually, you will be surprised when I tell you this. In a portfolio to do well, 60% contribution is client, 40% contribution is of any advisor.
Okay.
See, we are partly, the quantitative part is the numerical part, where I might, based on quantitative things, choose what is right for him. But what is more important in investment is the behavior when a certain thing happens. For example, let's say in beginning of 2000, nobody knew COVID was coming in March.
Correct.
So any of my quantitative models would have said that, okay, let's say India is still continuing to do well for the next 5 years, 10 years. And based on that, I could have met a client in January and asked him to invest in equity. But then COVID happened in March and markets fell by about 30-35%. Now, at that time, the behavior is more important. Now, does the client or me as an advisor have a view to look at markets beyond those 6 months and 1 year of pain? Can I digest that volatility in my portfolio, that notional loss in my portfolio, overlook and ignore it and say, okay, I'm here for the long haul, for the 5-10 years. If I've got more money, can I commit more at this point in time? When the world is only talking about, when this COVID is going to end and, so on and so forth. So can I actually take this as an opportunity to increase my exposure rather than decreasing it? So that is the behavioral part. That only a client can do, So I can only advise a client that it's a great time to stay invested or add money. But if the client is very uncomfortable or he's getting sleepless nights and he wants to exit the portfolio, there's only little I can do.
Right.
Nobody can guarantee the future. So I cannot guarantee my client that you stay invested and your returns will come. I can only say that it will probably come if you stay invested. So it is the client's participation, how he behaves during certain situations. The other extreme is the euphoric situation, where markets are doing extremely well. The clients say that, okay, let's put more and more money in equity. And then do you still have the behavior to act in a reverse fashion? Say that, okay, markets are too expensive now.
Right.
Let's ignore, the entire euphoria.
Right.
Let's take a conservative approach. Even though 6 months markets will do well, but our portfolios will not do very well because we have taken a conservative approach.
Right.
But we are here for the long haul. Let's ignore the next 6 months, 1 year. Just the reverse of when the market falls. That again, we can only advise, but then it's the client's behavior, his understanding, his faith in us as a client, as an advisor, which kind of actually helps us take those decisions, stay with those decisions, and then probably enhance the returns in the portfolio. So it's kind of a partnership where it is behavior and science, which is a combination of both. If one of them go wrong, the portfolio returns are not going to be great.
You strike me as someone who says it as it is. And is this how you approach? I'm curious because there are so many caveats in any application form that you fill, right? Especially if you're investing.
Yeah.
How is this how you are? It's so interesting. You're just saying it as is. I'm just curious to know.
This is how it is. These are the facts. So typically, it is extremely important that when you're approaching anything, you have the right expectation. So when we meet a client or whatever, so we don't want to give a client a flowery picture saying that everything is going to be great. So when we meet a client, also we are equal partners. In the long run, how you behave and the trust you show in us will probably also determine the kind of returns which you get in your portfolio. One thing is our assurance to our client is that I would not invest any money of my client where my personal or my family investment is not there. Okay, so if something is not good for me, cannot be good for my client. So any investment, if I have faith or I've invested my own money. So for example, the investment portfolio of my client just mirrors the investment portfolio of my family. So I would not have any fund of my client where I don't have personal investment in. So if I think it's only good for me, do I believe it will be good for my client? However, I might have a large exposure to equity. A certain client might have low exposure to equity. That's a result of the risk profile, not because I think it's good or bad. But then the same debt instrument which he has in the portfolio will be in my family debt portfolio. It will not be any different from that. So to that extent, we want to handle a client's money like our own money. And my communication with my client should be the way I communicate with myself, saying that these are the risks and these are the way you need to approach investments per se.
Got it. Now, in terms of HNIs, you said you focus on HNIs.
Yeah.
Why did you choose that customer segment?
So when I started in 2013, one of the reasons we started, in our industry, there's a lot of attrition, So relationship managers, wealth managers move from one company to another. So when they do, there are two options the client has. Either move with the relationship manager to a new company or see a new relationship manager. Right. In both cases, there is a bit of a disruption in his portfolio or the process. Because the new company could think differently from the old company, or the new relationship manager could think differently from the old. But in our industry, the person managing your portfolio is extremely important. Because as I said earlier in the interview, that only with time do we understand the risk profile of the client. When we see his behavior through market cycle. That is a learning in the partnership which we have over a period of time where we learn how the client behaves. And hence we can devise the portfolio which is comfortable with him and hence will give you the best optimum return. So that can only come with experience and looking at a couple of market cycles, one down cycle with a client and one up cycle with a client. So our communication with a client when I started was that I will continue to manage your portfolio and I would not have any relationship manager which will manage your portfolio, however big we become. Because that learning only stays with my relationship with him as to how my client has behaved over a period of time. And given that, there is only a certain bandwidth I have in terms of the number of clients I can handle. And hence what do you do is just go up vertically, in terms of the amount of AUM you handle, because I cannot spread myself thin. And I don't want to go back on my commitment by enlarging a team, having new relationship managers handling. So if it is, my smallest to my largest client is handled by me personally. And with the same approach I would have irrespective of the size of assets they have with me.
So then at some level you accepted that there's only that much you can grow in the conventional sense of how big the company gets. It's a very interesting.
So luckily in our industry, the growth is a function of the assets you manage. And today the richest person in India is a few lakh crore rupees. So that could be, I'm not to say that I'm good, but it's infinite potential to that extent.
Understood.
So while the number of clients, there is a limitation which I have in terms of how many I can handle.
Right.
But the amount I can handle is still could be very, very large.
Got it.
And we are now for example, in the last 10 years, we're growing by about 32-33% year on year. So this growth is coming without expanding the client base too large. So this is more coming through the existing clients investing more money with us, or we're moving up the ladder in terms of the minimum investments which we're getting from the clients.
Got it. How has the investment culture changed region to region? I'm curious. You're sitting out of Bangalore.
Right.
The notion, at least in the 90s, was that it was Gujarat and Rajasthan largely which did stocks or equities.
Yeah.
What about South? It was more land and gold,
Yeah,
like you
yeah.
said. Is that evened out? Regional differences? I'm curious to know India from whatever you've seen.
It's reduced, but I still believe in South, people still do love land. People love rental income. So rental income is something which I think is a big kind of a kicker for investments in the south of India, which is not as much as in the north and the west and the east. But in south, ಎಷ್ಟು ಬಾಡಿಗೆ ಬರುತ್ತೆ is like the king of everything. So a groom may not be earning well, but then if he's getting good rent, he's still an eligible groom versus a guy who's got zero rental income and kind of earning well. So that notion is still strong among the investors, but then it's reducing, by year. So the resistance we faced, say 10 years back, for a client to invest in say financial instruments as against say a rental yielding property or land is far lower today than it was 10 years back. But having said that, the preference still lies with real estate and rental income in the south of India. But then it's changing slowly.
And this you're saying across the spectrum or just HNIs?
Across the spectrum. But unfortunately, at the lower income brackets, it is difficult to own real estate because real estate cannot be divided into smaller pieces. So that way, it is more probably a financial compulsion of them not having real estate than the desire not to have real estate. But the desire lies across the spectrum, from a HNI to this. But then that's changing fast.
So what is the replacement investment that has taken over? You said that real estate is ceding space.
Yeah.
What are people looking at or bullish at? Equity? Is that what they're looking at?
Yeah, so equity is making a big comeback. So even if you look at the assets of the industry, equity assets are growing phenomenally. The other culture which I think has done, is changed the entire way, or not change, or is changing the way investments is looked at, is the SIP culture. So, today we have about 14,000 crore of SIPs going into mutual funds, which is a fairly large amount. So what SIP has done is they have done two things, with respect to the way, investments are kind of behaving in India. One is our dependency as a stock market to FII investment has reduced drastically.
Okay.
Because you are talking about, 1.5 lakh crore rupees coming every year only in SIP, plus the lump sums which come.
Right.
That is fresh inflow coming from a guy who can only invest as little as 1,000 to a guy who can invest a few crores, in SIP. Everybody's participating in that. And SIPs have done well. It's a good, simple way of investing as well.
Right.
So the experience also of investors have been good. So that is one. The second thing is, because the experience has been good through the initial SIP route, people are now willing, or at least open to investing lump sums from sale of land or any bonuses they're earning or whatever it is. So to that extent, I think equities has been a fairly reasonable replacement to the little change we have seen in terms of the attitude from real estate to other financial instruments.
And equity has taken the lion's share of the replacement, you think? What else has become popular?
Real estate, I would say, equities would have taken a lion's share from real estate per se. But again, how you invest in equities, there are various vehicles to invest. It could be private equity, it could be listed equity, but those are forms of equity. Then you could invest through a mutual fund, you could invest through an AIF, you can invest through a PMS, or you can directly buy stocks as well. Now, direct stock buying has also become, is becoming popular day by day. I mean, if you look at some of the broking firms now, and one of them is based out of Bangalore, they have become fairly large, adding a few lakh accounts every quarter, So a lot of new investors are coming who are wanting to buy stocks and so on and so forth. So I think, the entire culture is building. And then today, if you look at in India, our equity domestic exposure is about 4.5%. Countries like US have plus 30%. China is in double digit. So we have a long way to go from where we are to where we could be in terms of our household equity exposure as a percentage of our assets.
Actually, an interesting point you make. So then, if you had to, I know lots of things can change, like COVID has taught us.
Yeah.
If you had to predict the next 10 years, are you largely seeing a bull run in the stock market? Is it a good time to stay in the equity space?
I would believe so. See, you can never be certain about markets or any asset class for that matter. But then, given the factors which are available for us to consume today, we believe India should do extremely well over the next 10 years. And if India does well as a country and as an economy, there is no reason why the stock market should not do well, because market is a reflection of the economy, you know. So there are 2-3 reasons why we think the country should do well. One is we have typically been a service-oriented economy as far as exports are concerned, you know, and Bangalore is the hub of it with the IT. I think a lot of manufacturing is going to come to India over the next 5-10 years, you know. So we've been hearing about this China Plus story where people are wanting to diversify. What has happened in the last 3 years, which has played extremely well in India's favor, is one with COVID, where the entire supply chain globally got shut, and second thing with the Russia's invasion of Ukraine and the entire gas supply which was threatened and kind of got shut. The learning for the world is how do I diversify and not concentrate all my bets with one economy, you know. And hence they would look to diversify out of China, manufacturing, because today, you know, the most of the manufacturing globally happens out of China. So then what is the country where they could look at? You know, you have to look at some emerging market because the cost of labor is cheap, you know, land and so on and so forth. In that, India should get a reasonable share, if not the lion's share, you know, because not only do we provide the necessary ingredients for a good manufacturing hub, but we have a great domestic market as well. So a foreign company manufacturing in India will not just export, like for example, say Apple, will not only export iPhones, but also there is a huge iPhone market within the country and growing. So it's a dual advantage for them. As against them setting it up, let's say in a Vietnam or a Thailand, the domestic market is far smaller. You know, so all things being equal, India would be a preferred destination for them as compared to say a Philippines or a Vietnam or a, you know, Indonesia or whatever. So that's one. Second thing is over the last, first the Lehman crisis and then the IL&FS crisis in 2016-17, most of the companies reduced their debt because, you know, the markets were not looking at companies with high debt favorably, you know, because of all these crises. So today the corporate balance sheets are the best I have seen in my 22 years of career. And probably the best people with larger experience than me have seen in their entire lifetime, you know. So the corporate balance sheet looks great. Banks again cut their NPA levels, you know, and so on and so forth. The banking balance sheet looks great. The consumer balance sheet, which is the third pillar of this, has always been good. You know, in India, we don't leverage that much as they leverage in the Western world, you know. So though the leverage is going up year on year, but still it's at a very, very comfortable level. So the consumer balance sheet is looking great. The the government balance sheet is okay, you know. So, and in India, government balance sheets have never been great, but it's not bad, you know, it is okay. So you have 3 balance sheets which are looking great: corporate, consumer, and bank, and 1 balance sheet which is looking okay. And coupled with the fact that you might get manufacturing into India. So I think we are poised for some good times over the next 5-10 years, and that should translate into good returns and equity as well.
Great. What do you do when you're not working? Let's just talk a little bit about you. We've spoken so much about finance.
Yeah, so I love playing golf. So that's also kind of helped me professionally, you know, not so much in terms of getting clients, but then golf is a great platform where you can talk to people from various aspects of life and who have done well in those niche areas of them. And there's so much to learn, you know, and that learning helps you in your decision making in terms of what things might do well and may not do well. So they may not necessarily invest money through me, you know, but then the learning itself translates into adding more experience in terms of decision making for me. So that's one. And second, of course, I've also made a few clients on the golf course as well, but that is the secondary thing. So I love playing golf, you know, and then the usual, every Indian loves watching movies. I like watching movies as well. You know, so that's another thing which thing. And then the reading also does take a long time. So in our industry, you know, I think it's extremely important to keep yourself updated continuously. So reading does take a lion's share of my time, you know, in terms of the way investments should be done or about the economy, about the companies and so on and so forth. So that's another thing, which partly is work related, I could say, but then partly is also my passion in terms of wanting to do that.
Interesting. The other thing that I found quite interesting in your website was philanthropy.
Right.
That I'm sure is a new space that is emerging, right?
Yeah.
How, can you tell me a little bit about what you've seen or how that space has evolved?
Yeah, so I think, especially with the space which we cater to, which is the HNI space, I think most of us are what we are today because we've got something from the society. See, it's a zero-sum game, right? There's only so much wealth in the world. So the guys who've got more wealth have got a larger share than the average. So we are above the average. People have got. So I think there is some bit of responsibility. I would say. I wouldn't even say philanthropy. It's a responsibility where we try and give something to the ones who are below average. Because our clients and also probably me, we are above average and we are fortunate because of certain factors which played in our life. So we are at the position we are. So I think philanthropy is an extremely important thing. I think it's a responsibility of every individual to give it back to the society because what you are today is from the society.
Yes.
And I think it's an extremely important aspect in terms of one's portfolio and an allocation from the portfolio saying this is what I want to do.
And has there been a growing interest? The last thing, we'll just wrap it up. Has there been a growing interest from the HNI saying that I want to give away more because the wealth has definitely exploded? Or how has that evolved? Did you always have them back in the early 2000s also, let's say, as you started your career? Or is that a new phenomena and is getting more popular now?
I think it's getting more popular for two reasons. One, as you rightly said, the wealth is also growing. So now they have a little more surplus, they feel confident about their future and they see, okay, I have more than I require for my future and hence I can give it away, because and the human tendency is to be inward looking, first we want to see we are totally covered and then we look. So now obviously the feeling of being totally covered is much higher than it was 10 years back because, the income levels have gone up, the markets have done well and so on and so forth. And second thing is, people are also becoming more aware that, that is the right way to approach, in terms of life and give away. But then every client does not. But some clients do. Some clients are getting there in terms of doing it. So I think that is something which
Can you give me an example of what you've done in this space? One of the most interesting bits to the extent you can share. I'd like to hear how you go about doing something like this.
Yeah, so see, again, it's individual decision making. So there are basically two types of charity an individual can do. One is religion based and one is non-religion based. Personally, I don't do religion based. I'm not an atheist, but then I don't believe in religion based charity. I'd like to do the non-religion based. And in the non-religious space, I believe the best way of doing charity is education based. Because when you help a child getting educated, you're eradicating poverty for its entire generations, because the moment a child gets educated, gets a job, she or he can kind of educate her or his children and so on and so forth. So personally, I do a lot of charity on the education side in terms of helping people with the studies. But then it's one's comfort. As long as they are putting it away in whichever area they are confident or comfortable with, it is fine. So nothing to say my approach is right versus theirs. It's just your comfort. The other thing which I think I should touch upon, though you've not asked me, is
yes, please.
We are also focusing on something called staggered retirement. So that's another concept which I think is becoming. It's a new concept becoming slightly popular. Is that so? Most of the time, people see that they want to work, and they have a retirement age in mind.
Correct.
Either government determined or non-government determined. Right. They'll say, okay, at 58 or 60, I'll retire, and then I'll spend time for myself.
Right.
But then, typically, to have a good, life or enjoy a certain thing, you need money, you need health, and you need time.
Correct.
Three things are important.
Correct.
At your old age, when you retire at 58, 60, you may have the money. And then you are getting yourself a time, but then you may not have the health. You might have blood pressure, you'll have diabetes, or arthritis and all that.
Right.
So there is a time where you have to start enjoying when all the three are still there.
Yes.
So
absolutely.
Typically 40, 45 is the time where you made reasonable amount of money, to start to feel comfortable. You have to take time out for yourself, because at that time is a scarcity. Health is of course there for most people.
Right.
So now what we are trying to advocate to our client is, at age much earlier than retirement, could be at 45, 50, can you spend 4 or 5 hours in a week for doing something which you like doing? It could be anything, watching a movie, going out for a holiday, just a drive, playing golf or playing any other sport or whatever. And can you increase that time as you get closer to the retirement? So instead of having a cliff where you're working and just drop off and then I want to enjoy life, can I make it like a slope where I say that, okay, I want to spend more and more time for myself,
Right.
Of course, time is a compulsion because, you have a job to
Correct.
do and,
Correct.
there are other things. But then I think a lot of it can be planned, and if you put in an effort, in terms of time management, delegation, and so on and so forth, that can be procured. So we have actually seen a few of our clients who otherwise would not spend any time for themselves, having to start spending time doing something which they like doing. And that makes them happy about the entire concept of money and all that. See, money can grow in the bank or, in the portfolio, but that doesn't do anything for you because it's just growing in your balance sheet. Only when you make use of that money is where the enjoyment comes.
Correct.
And instead of waiting for one particular time in the future when you want to start enjoying, can I start gradually using that money which is lying in my portfolio is something which is very important. Which is quite counterproductive for us because the money is going out of our portfolio and our assets. But then that's not our job is also to look at the entire interest of the client. So that's something which we are trying to kind of push our clients to do is trying to spend time for themselves.
Very good. I've had a great time chatting with you. I hope you
Pleasure.
did too.
Pleasure.
Thank you for talking to me.
Thank you so much. Thanks for having me.